All right, thank you. So I'd like to thank everyone for joining us today. Today we are going to be hosting another forum program as part of our year-long Ohio Fair Lending and Vital Communities series leading up to our fall conference. Today's program, we're going to be looking at property assessed clean energy loans for residential properties. Similar loans and loan products have been made for commercial properties for a number of years now, and in some cases have proven beneficial for some Ohio cities and communities. But what we're going to be looking at is the residential version of these loans that are meant to offer homeowners loans for a range of energy efficient repairs and improvements. We'll hear from a number of folks today who are going to share information from other places across the country where these residential PACE loans have proven problematic and in some cases disastrous for some homeowner borrowers. We're going to look at the differences between residential and commercial PACE loans and get an understanding of why the loans made for residential properties pose a far greater risk than those that have been made for commercial properties over the years. I think our real hope is that out of today's program, that communities will come away with a stronger commitment to have deeper public deliberations before entering into these agreements and before giving approval for residential PACE loans to be made in their communities. With that in mind, with us today to share what they know and what they have learned in their experiences are, and I'll read them in order of their speaking order today. Stephen Sharp. Welcome, Steve. He is the staff attorney with the National Consumer Law Center. He focuses on foreclosures and mortgage lending. Steve has represented homeowners in his work with the Legal Aid Society of Southwest Ohio and Indiana Legal Services. He's a contributing author of the National Consumer Law Center's Mortgage Servicing, Loan Modifications, Home Foreclosures, and Truth in Lending legal treatises. He's a cohort member of the Shriver Center's Racial Justice Institute and a consumer fellow with the American Bar Associates Consumer Financial Services Committee. Steve's going to give us a background on PACE and share experiences from California and Florida. Then we'll be hearing from Jeremy Kohler, who is a reporter with ProPublica, covering issues in Missouri and the Midwest. Jeremy joined ProPublica in January of this year. So pretty new to that publication, but prior to that, he spent more than 20 years with the St. Louis Post-Dispatch. Since 2003, among other newspapers, I'll say, since 2003, he has served as an adjunct journalism instructor at Washington University. He's going to be sharing his research on the PACE loan experience in Missouri and how it has impacted homeowners there. We're also going to hear from our own Frank Ford. Frank is the chair of the Greater Cleveland Vacant and Abandoned Properties Action Council, better known to us locally here as VAPAC. He's a licensed attorney who has worked in the field of community development for 40 years. Frank's work with communities has included activities in the areas of housing development, commercial retail development, organizational development, human capital development, and applied research, which we all love to see when Frank comes out with new data and information. I always look forward to that. He'll share with us today some of that research from VAPAC that he's done, and he'll also examine some of the advocacy related issues regarding PACE and get into the shortcomings of some of the consumer protections that may make Ohioans vulnerable to these loans. And our fourth panelist today is Antoinette Smith. Antoinette is the Director of Housing and Financial Counseling at ESOP, or Empowering and Strengthening Ohio's People. She oversees the housing counseling program. She's a HUD certified counselor and has more than 2 decades of experience in providing direct services for clients who present with multiple needs in our communities related to finances, housing, and health. Antoinette's going to share with us her on the ground experiences and talk to us about how homeowners should be protected in light of past experiences with predatory lending. I'm going to turn it over to Steve.
Thank you, Molly, and thanks everyone. I appreciate the opportunity to join you all. And so now I want to pull up my slides and we will kind of get started here about PACE. So again, Steve Sharp, National Consumer Law Center, based in Ohio, was an attorney a long time in Southwest Ohio, still based here, and really happy to join you all to talk about program that's coming or could be coming to you, and to think about you know, what you need to know to understand the basics of it. Some of the things we've seen from a nationwide perspective in the few states that have adopted residential PACE, and then join Frank later to talk about some of what we see in Ohio. But really, my job here is to set the stage, and I really appreciate the opportunity to join you. Even before I jump in to what is PACE, I think framing the question here is extremely important, especially around residential PACE, especially in light of the fact that we know that there is a dearth in some communities of lending opportunities, and at the same time, some real repairs that need to be done on homes. So I think the way we at NCLC like to frame this question, especially in light of all that, is what is necessary to make PACE loans safe for consumers? You know, it's really about what is the safe way to do it. What are the protections in place to make sure this is a safe financial product? Because that question is not theoretical, and we've seen, and I'm really looking forward to Jeremy's presentation, because we've seen that if those protections aren't in place, PACE can really be a problematic loan program that can put people in real harm and cause some pretty big financial circumstances. So as we think about PACE, and as we know that there is, I guess, increasing proposals at a community by community level to have PACE adopted by the industry at the municipal level, keeping that question in mind of what's necessary to make it safe. And then, of course, if what's being proposed is enough to make it safe. Spoiler for me, I don't think what's been proposed in Ohio does make it a safe program, but we're going to let Frank go through that with me chipping in. So first, let's kind of define what PACE is, because I think good to be all on the same page. So it is property assessed clean energy, and these are in this program that's being considered home improvement loans offered through contractors. So the contractors have been the access point for which homeowners are accessing these loans, and they are for energy efficient and renewable energy improvements. So when we think about the housing stock, they aren't for, you know, kind of the myriad of issues that are necessary for home improvement loans. They are there for energy efficiency. But so PACE loans, however, why are we talking about them? Because they operate a little differently than maybe a credit card or some other type of non-secured financing. The key feature about PACE loans is they are attached to the homeowner's tax bill. So people originate them through a contractor for energy efficiency, but they are done through property taxes, which is why municipalities need to be on board to allow PACE loans. So you can have a structure at the state level to allow it, but again, it has to be approved. This program has to be approved at a local level because the loan is paid through the tax bill. So this is why it's really crucial to get this right, because as we know about property taxes in Ohio and in most parts of the state, they are a priority lien against the home. So in some of the discussions, some of the industry conversation has been about, you know, PACE is really in competition with a credit card, and they offer lower rates than credit cards. That's another tool to finance improvements. But here is a fundamental difference between a credit card and a PACE loan. PACE is not only attached to the home, but it is a priority lien on the home. So that if the homeowner cannot pay the home, it can be at a very increased risk of foreclosure. And that can either be foreclosure through the tax foreclosure process, when this loan is made on a home that does not have a mortgage, but it can also be through the mortgage foreclosure process. If there's a mortgage and the mortgage company pays escrow, pays property taxes, and then adds it to the mortgage bill, we can also have an increase of the mortgage payment in that way. That then would, of course, put the homeowner at risk of foreclosure. Either way, the real key here is that if you do not pay a PACE loan, your home is at risk. At risk at a fundamentally different level than it is if you do not pay a credit card, which you can go through the judgment process and we could talk about the mechanics of that, but it is nowhere near as simple to attack collateral with a credit card than it is for a property tax lien. So it is that fundamental aspect of the PACE transaction that makes it so important to get right, because we are talking about homes at risk. And so when, if there is any conversation about this difference between a tax and between a credit card and PACE loan, please keep in mind that it is really more like a mortgage, and in fact, even more than a mortgage, because it can be a priority lien on the home. So, and that failure has been, and the issues that we've seen are not theoretical. Jeremy will tell you, go through what he's seen. But we have some stories and some of the material that's in the slides. And again, I'm sure these slides, we'll figure out a way to get these slides out to you. But we have some links and some stories in the material that show some issues. But I want to walk through what we've seen. So I think the problems come in different buckets, and each of them is important to figure out how to have protections in place to assure that these aren't issues. So you want to think about it from a loan, like the loan perspective, the actual financing aspect of this, and then in the contractor misrepresentation work aspect. So even among these buckets, kind of have different buckets. So the first is making that kind of mortgage loan without a true ability to repay assessment. And that is a thing, it's something that we have seen in some of the stories that we've collected are in there. And I think a real fundamental part of this, that in Jeremy's story. So if you, well, like a mortgage, think about mortgage underwriting. When we're talking about putting home as collateral, the rules for underwriting mortgages are very detailed and really truly make sure are at least aimed to make sure that the lender is documenting income, having a reasonable ability to pay standard, and making sure that the homeowner can afford to pay what they are borrowing. And so what we've seen is insufficient protections on this ability to repay, so that homeowners aren't truly being assessed in a way that's reasonable. So, and again, Jeremy is going to go through that part of it in depth, because that's really key. So that is on the financing part of it. Another thing that we have seen is contractor misrepresentation. People being promised work that either being told work, I guess actually this is kind of can come in both in the misrepresenting of what would be appropriate work to be done on the property, and then also misrepresenting the nature of the PACE transaction. Things like it's a tax, because it's, you talking about things as though they're tax breaks and inflating the tax break aspect of it. So we've seen that, and here is where I want to commend to you all. I did not put the link in the PowerPoint. I don't know how people feel about strong language, but there are some in here. I really would commend the John Oliver piece that he did, which you can find on YouTube. So this is something through HBO that really was a live 20-minute full video presentation about some of the problems with PACE. And you can see in that John Oliver piece what kind of contractor misrepresentation borrowers have talked about, but it is certainly there. And so there's the misrepresentation part, and then the poor and unnecessary work part. And again, the poor and unnecessary work part of this becomes really important because of how the PACE loan is attached to the property. So this isn't just a dispute over money, but when it comes through a tax lien, if there are not true protections in place to talk about what happens when there is poor and unnecessary work, again, it's not just a deal gone wrong and a dispute between the contractor and the borrower, or sorry, the contractor and the homeowner, but then we have the PACE loan that comes into place. And then finally, the high cost and high balance loans. So these are at interest. They are financed over time, so that, and this ties in with the ability to repay, that they are can be an extraordinary amount of money, especially for people who don't have the ability, if there's a question of the ability to repay. So we've really seen, and again, we have not only in our material some of these problems, but you can see it in John Oliver piece and some of the stuff that Jeremy is going to share as well. And I think the best way to illustrate, so this is the material we have. We have stories in the in our PACE collection, and also in comments that we made to the CFPB, and that's the Consumer Financial Protection Bureau, and they are considering a rulemaking on PACE to put rules in place at a federal level. So one thing to do is to think about how waiting to see what the CFPB does before adopting any rules yourself. But I think the news is frankly as good a way of illustrating what is going on. And there have been a significant amount of stories in the news about what's going on with PACE. So there is not only Jeremy's two great pieces, but there was also a piece in Bloomberg about the subprime solar trap for low-income homeowners. So there have been national stories about the program, and we have places in California and in Florida who are backing out of the program because they've seen what it can happen to people on the ground. So, I think about this very carefully. At a time when Ohio municipalities are thinking about joining in, we have, these are just last year, LA County, others places in California, large Florida counties interested in backing out of the program. So I think learning from what has been learned in Florida and California is incredibly important, and I do think should guide Ohio municipalities in making decisions. So just to back up and to think about what's happening in Ohio, so we've had PACE authorizing legislation since 2010, and the commercial PACE program that was referenced before, which for the most part has been regarded as successful. But again, thinking about what makes a program safe from a residential side is much different than what it makes it safe from a commercial side. And so in 2019 was when Renovate was selected by the Toledo Lucas Court to start a PACE program, residential PACE program across Ohio. Renovate filed bankruptcy in December of 2020, has passed its contractual rights to Y Green Energy Fund through the bankruptcy, and it is Y Green who released a press release, I think just a few weeks ago, that they are ready to start up with the 30 or so municipalities that have signed on a PACE program. And they claim that they have the strongest consumer protections in the home improvement financing industry. This is a quote from their press release. We have obtained the consumer protections. These are not easy to get because they are passed at the municipal level. They're not like very clearly posted. And Frank is going to go through some of the issues. But before he does, what I would like to do before Frank and we hear from Jeremy and then Frank kind of ticks through, I think it's useful, given the experience, to set up a few kind of standardized ideas of what would make it safe. And so, this isn't necessarily anything, and this is everything, and this is just a kind of summary. but it is responsive to what we've seen on the ground. So the first is you need to make sure that you're verifying and documenting people's debt and income, and have some sort of third-party verification of that you can trust from both an income and a debt perspective. This isn't rocket science. This is just good practice if you're going to make a loan that is attached to the property and that the person could lose their home as a result of. So just verifying and then having a reasonable standard for how to assess whether the person can repay. So just basic, can you afford this? And really having it in two buckets, making sure that the information is right, and then having a reasonable standard in place. Then, I think when we're talking about loans that are made through contractors and we've seen door-to-door contractors originating these loans, making sure people have a right to rescission and cooling off period that is about the financing, not just the repairs, but recognizing that we have both a financing aspect of this and a repair aspect of it, and we need a right to rescind and cooling off period for both of those. Then we need contractor oversight. So many of the issues that we have seen come through contractors misrepresenting or making false claims or problematic statements about the program. So we really need true contractor oversight. And then lastly, when these problems happen and when the standards are not met, there needs to be clear and explicit consumer remedies for addressing the loan aspect of it. Because if not, then we could have, if the loan is not made pursuant to the homeowner's ability to repay, and the rules are not followed, there needs to be some recourse for the consumer so they don't threaten a loss of the home. So I think I'm right about on time. I'm going to pass it to Jeremy. Frank's going to go through how the Ohio consumer protections match up, and then we can talk a little more. But I'll be around, happy to engage in the conversation. Hope that was a useful summary, and I will pass it to, I'm going to stop sharing my screen and pass it to Jeremy.
Thank you, Steve. Hi, everybody. I'm Jeremy Kohler. I've been a reporter with ProPublica since January, as Molly mentioned. I previously worked as an investigative reporter with the St. Louis Post-Dispatch. And I live in and I'm based in St. Louis County, just outside St. Louis, talking to you today from the Chicago Bureau of ProPublica, the Midwest newsroom. Just a bit of background. I started looking at this when I was still at the Post-Dispatch, covering St. Louis County government. I noticed that a bill had been filed in the St. Louis County Council that would help this group of financiers that run a PACE district called the Missouri Clean Energy District, who were middlemen essentially for Renovate America, would help these guys gain access to a greater share of homeowners in St. Louis County. And I looked more closely at it and I saw that while Missouri Clean Energy District had most of the Kansas City area and the far west suburbs of St. Louis, they were not the dominant company in St. Louis and St. Louis County. Another group was that had won a contract with St. Louis and St. Louis County. These guys were called Energy Equity Funding, or EEF, and they had contracted the residential side out to Y-Green. And so Y-Green ended up buying out EEF outright. So Y-Green is now the contract holder in St. Louis City and County for PACE lending for residential. And so from the start, Missouri started a couple of years after Florida and California. But from the start, the Missouri Clean Energy District guys and the EEF guys were just kind of battling it out for market share in Missouri. And so that's in trying to limit the other companies' market share. But to say that the industry was operating quietly would really be an understatement. I hadn't heard anything about this. I saw this bill filed on behalf of Missouri Clean Energy District, had never heard of it. Talked to people in the county government, they had never heard of it. There's no advertising for PACE. There's no, there's no web presence. So how do you find out about it? Just like Steve said, this is something that for most consumers, they're going to find out about it from the contractor that they called to put in HVAC system. And typically it's going to be the loan of last resort because the interest rates are higher than what you would get if the contractor has financing through a bank, or if you could get a HELOC, or if you could refinance. The contractor is going to say, well, we have this program where you don't pay anything down. You might not even have to pay until the end of next year. And we'll come in and complete the project. You can sign the dotted line, and then you'll pay it back through your tax bill at 8% interest rate. And so that's going to sound pretty good. I filed a sunshine request with St. Louis County. St. Louis County had its own PACE board for their annual report, for their minutes. And I was lucky enough that I found that in their earlier annual reports from 2016-17, I believe, they had addresses that listed the residential projects that they had financed. And so that was really my first insight into it. My first observation in looking at St. Louis County's projects was that a disproportionate number were from North St. Louis County in the suburbs, including and surrounding Ferguson, which is the area where I live. Property values, North County have taken two big hits in the last decade. First in the recession, and second around the time of Ferguson unrest. North County has the highest proportion of African-American residents. So when you see a lending program that has a disproportionate number of customers there, that's something to note. And I just was sniffing around to see if there was a story here. I started running some addresses and pulled up the homes of some of the borrowers on Google Maps just to look at the house. And I was like, oh my God, this house isn't, this house got a $15,000 PACE loan, and the house is not even worth $15,000, $10,000. One particular house that we talked about in the story actually had a value of $2,000 that had gotten a $15,000 PACE loan. And so it was fairly easy. It's fairly easy to look up tax records in St. Louis City and St. Louis County. And I could see that on many of these low value houses, the taxes were delinquent at least 1 year, which, as Steve mentioned, if you don't pay your taxes, then you are heading toward a possible tax sale. Most counties in Missouri, the county will, the collector will sell the houses at a tax sale after 3 years of unpaid taxes. So it looked like there was a story here. I was also able to pull some of the liens. When you enter a PACE contract, a lien is filed against your house in the Recorder of Deeds office, so you could see the terms of the agreements that people were entering, and the loans were usually at 8% simple interest with fees. And the first payment usually wouldn't be due until you would pay your tax bill, which is due on December 31st in Missouri. And so in some cases, the first payment wouldn't be due till December 31st. And then if you were at a certain point in the year, you could even elect to have your first payment December 31st of the following year. But they would charge you the interest for that period up front, and that would be added to your principal. So it'd be capitalized interest. So that would add to the principal that you had to pay off. And then there were program fees added in to the loan, like a closing cost, and then administrative fees added in to the annual payment. And so what is advertised as being 8% is really quite a bit higher. So I brought this story idea to ProPublica when I started, and I was lucky enough to pair up with Haru Corinne, an excellent data reporter, just an excellent reporter at ProPublica. Had a strong background in real estate reporting, and so he took a keen interest in this. And he came up with a methodology for how we would analyze the whole system, and that nobody had really done it before in California or in Florida. Just really cracked open the whole system and took a look at it. We ended up obtaining every lien that was on file in the five biggest, in the five busiest PACE counties, which were St. Louis City, St. Louis County, and St. Charles County in the St. Louis area, and then Jackson and Clay counties in Kansas City. And so it was 2,800 liens altogether that were on file. We actually spent a good amount of money unlocking the liens from St. Louis County, which were trapped in this proprietary software system, which is a story for another day. I think we ended up spending about $3,000 on obtaining those records, which is quite an investment. And I also filed sunshine requests to the state for all of the PACE program annual reports around this time. They came back mostly redacted, but I was lucky enough to see some of the addresses in the city of St. Louis, and I did the same thing. Just pulled up the tax records for the houses I could see, I began to realize that in some wards in the city of St. Louis, especially North St. Louis, the delinquency rate was over 50% on some of the PACE liens. I think there was one ward, the second ward in St. Louis, that had 8 loans, and 7 of them were delinquent at the time that I pulled the records. And most of those were delinquent at least 2 years. So Haru actually mapped out the loans statewide that we had pulled to see where they were, who was borrowing, and which ones were delinquent, and then also compared the value of the loan to the value of the home. And lo and behold, the loans that were in the majority Black census tracts, 28% of them were delinquent at least 1 year. And while in majority White tracts, there was just 4% that were delinquent. And the homeowners in majority Black census tracts were also paying a much higher share of their home's value toward interest and fees, sometimes more than the house was worth according to the county assessor's office. So ultimately, we found that there were more than 100 homes with PACE loans in Metro Kansas City and St. Louis that were at risk of being sold within a year. These were all homes that were at least 2 years behind on taxes. And of those, 29 are actually on the tax sale list for this year because they are 3 years behind in taxes. Actually, I will share. Okay, let me. Okay, I wanted to show you the chart that we ran with our story. This is calculates costs as share of home value. The blue dots are the majority Black census tracts. So each dot represents a census tract, and the yellow dots represent majority White census tracts. And you can see that in the majority Black census tracts, they're paying much more in costs, in financing costs relative to the value of their home. And so we actually separately broke out the interest and fees that people were paying. And so we compared only that to the value of the home. This is This is a photo of a man that I interviewed, Wasim Aziz. He's entering his home in Wellston. Wellston is a municipality in St. Louis County with an extremely high poverty rate. Wasim had borrowed $10,000 through a PACE program for a new HVAC system. The contractor came and basically put the furnace in his basement. Wasim believed that the contractor was going to hook up utilities. That the house has no electricity or water. The contractor just left it there essentially. So Wasim had been camping in this house for over 2 years until I went to talk to him. The county assessor values this house at $2,000. So obviously the loan to value ratio was considerably out of whack. Let's see. And I went out to Kansas City and knocked on doors, basically knocked on doors all over Kansas City and St. Louis of people who had borrowed through PACE, both borrowers who were delinquent and those who weren't. There was in Kansas City, there was a woman whose home I visited. I knocked on her door and she ended up being the lead of our story. Her story was very typical. Why did you borrow through the PACE program? Well, I had no other choice. I had no other choice. I needed to move into my house. This was the only option that I had. And as soon as I saw my tax bill, I said, oh my God, what have I done? So there was a mix of people who didn't know what they were getting into in terms of cost. There was still quite a few people who did know, who went into this knowing this was going to be very expensive, but it was a problem they could deal with later on. Taxes wouldn't be due until the end of next year. I know this is going to be hard. Maybe I can save up and make the payment. But ultimately, the house falls into delinquency. This is an example of one of the real estate tax records from the city. Going back, this is a home in St. Louis City. An elderly couple live in the home. When I knocked on the door, the gentleman came to the door. He was in his 80s. He had an oxygen mask on. He had been ill. He'd been in the hospital. I asked him about. I told him I was knocking on his door because you can see from his tax records in 2018. First of all, this is just in 2018. His tax bill was $2,510, of which $1,917 was for the PACE assessment. So his tax bill without the PACE assessment was only about $500–600. And he made that first payment. That was his first year. His second year, 2019, he made half the payment. And so he still owes $1,900. Third year, 2020, he didn't pay. So he's 2 years delinquent on his tax bill. And he said that, COVID and the work, it was tough to make money, and the family was struggling. They just figured they'd pay it off. But this was pretty indicative of what we saw when we knocked on doors. There was another. There was one home in St. Louis where the homeowner was up to date with her PACE assessment, but the loan to value ratio was just enormous. It was like 7-to-1, it was a home that she had owned for years. She had used it as a rental unit, and she just didn't. The house needed work. It's in a neighborhood of St. Louis where a lot of the block has just been lost. The house has been demolished. There's houses on either side of hers that are just crumbling, and she just didn't want her house to fall apart. And so the only way she could was to go to contractor and sign up for a PACE program. And she was late. She got sticker shock that first year. So she was a little bit late, but she made that payment, and she's got 17 more years of payments, at almost paying the full value of her house every year to keep the house standing, essentially. This is something that has appeared. I think if anyone from the first Suburbs Consortium is watching, they will recognize this slide. This was actually submitted from Y-Green to the City of St. Louis's PACE program. You can see that they break down their claim on what their PACE assessment cost. $15,000 principal at 8%, 20 years. Then you'll pay $15,000 in interest over that time, and you'll pay $15,000 in principal over that time. So over 20 years, you'll spend $30,000 to pay back a $15,000 loan. But what we found is that it's actually quite a bit more expensive. This is pulled from one of the liens that was on file in St. Louis County, I believe. You can still see the interest rate is 8%. The project cost is $15,000. And then you see the program fees, the capitalized interest, the annual administration fee. So the annual special tax payment is $19.14 for 20 years. That's $24,000, right? 2,000 times 20. So it's actually quite a bit more expensive than $15,000 in interest. You're paying an awful lot more than that. If any of my co-panelists have any questions, something I didn't cover, please feel free. I should also add that Y-Green and the Missouri Clean Energy District in Missouri, they both acknowledge, actually, they embrace their role as a lender that is providing cash to people who have no other access to cash. And so that is really their main sales point. They compare themselves favorably to high interest credit cards or payday lenders, and it is, say that they're a better option than those high interest types of loans. And so that's really the niche that they've taken out in Missouri. Now, one of the consumer protections that they have touted in Ohio is that the borrower can borrow no more than 10% of their annual income. And so that actually, if they're held to that, I believe that could actually really limit the amount of loans that they would be able to make in Ohio. I believe that the median income is in the $35,000 range. So that would be, if that holds true, then the borrower, your typical median borrower, would not be able to borrow more than $3,500 for a project. So that would really potentially eliminate some of the really lopsided, projects that we saw in St. Louis.
Well, Jeremy, and I'd like to just to add it, I think like so crucial in what you just said is that if they are held to it, and I think it's that problem of oversight. Certainly they wouldn't want to make a home loan that's well over 100% of loan to well over 100% loan to value, like they said in Missouri, but it happened anyway. And so I do think, and I know Frank's going to get into it, it's that they can have their own standards, but if there's not the oversight, if they are held to it part of it, that really is really crucial here. And I think it kind of goes to underscore what you said, because it did happen where we're in Missouri.
Yeah, and I also, there's a requirement in Ohio that they, that the loan be no more than, I forget the percent, I want to say 15% of the property value. But they determine the property value. And so in the cases where we showed that the house, that the county assessor had appraised the house as being worth $10,000 or $20,000 or $2,000, they just flat out said, that's wrong. We don't agree with that. That's not the real value of the house. And so we went back to the county assessors and said, look, they're saying this house is worth, if they're saying that their loan was okay, then they're saying this house was worth $80,000. And the assessors were like, find me a comp in that neighborhood in the last 15 years at that rate. So, they're using a third party to place a value on the homes to underwrite their loans. So, if they do the same thing in Ohio, then I think that could be an issue.
Okay, Frank, you're up next for us.
Okay, I'm just getting this set up. Is that, and Molly, is that appearing on your screen okay? I just want to confirm.
Yes.
Good. All right. So Frank Ford, Senior Policy Advisor, Western Reserve Land Conservancy. I'm just going to start with some background that might be helpful. There is a great need for home repair resources in many Ohio communities. A survey was done in Cleveland in 2015 and rated all Cleveland homes in an A, B, C, D, F rating scale. The A and B properties generally didn't need much repair. The D and F properties, of course, were significantly deteriorated and many were condemnable. It was the C-rated properties where home repair programs are really needed, home repair loans. And as you can see, there were 17,500 in 2015 that were C-rated. There was a disproportionate number on the east side, which is 80% African-American. There were 73%. On the west side, there were 27%. The problem is that then home repair loans are not equally accessible in all communities. And this is looking at Cuyahoga County. And what you can see is the blue bars are the percent of loans that were made based on applications for home repair loans. The beige bars are the percent of that community's African-American population. And the left is the outer suburbs, the west inner suburbs, then the west side of Cleveland, the east inner suburbs, and finally the east side of Cleveland, 81% African-American. As you can see, there's a descending, as communities become more predominantly African-American, their ability to access home repair loans is significantly less. Then I want to look at tax delinquency, since this is important because of this PACE program is connected to a homeowner's taxes. Residential property tax delinquency has increased dramatically in the wake of the foreclosure crisis, and now more recently after COVID-19. You can see the 90 million back in 2010 progressed to 232 million. Actually, there was a little dip here, and I do want to give credit to Cuyahoga County, has been working with housing advocates to try to improve tax collection and help homeowners who are in distress. But COVID really sort of gave this a curve, and now we're up to like 270 million. And again, just like with the home repair loans, delinquency is disproportionately, it's highest in the two Cuyahoga regions that were hardest hit by mortgage foreclosure. The east side of Cleveland, 80% African-American, has the highest tax delinquency. The east inner suburbs, 52% African-American, the next highest. And so I think, well, and one more thing here, and then looking at COVID-19, the last 2 years in particular, senior citizen homeowners increased, their tax delinquency increased by 29% from 26 million to 33 million in Cuyahoga County. So with that in mind, my conclusion is that adding PACE loans to property tax bills should be approached with extreme caution and with maximum protection for Ohio homeowners. And I want to get into the things, the specific things that I want to talk about with PACE. So some troubling characteristics of residential PACE financing. The first being something that's already been talked about. This is a program promoted by and driven by contractors who, at least based on past experience in other states, would go door to door, then be in somebody's living room, giving them a high pressure sales, and the end result is a super priority lien on the home. There are two major concerns that I want to talk about. As you listen to Jeremy and Steve, there are not just two concerns about residential PACE. There are two that I want to focus on. One is there's no assessment of the home to determine, the contractors there trying to sell the homeowner something. They're trying to sell them solar, they're trying to sell them windows and doors, but is what they're trying to sell the repairs that homeowner needs? There's no third-party verification. Then my second major concern is there's no third-party verification of the homeowner's ability to repay. And Steve, I think already talked about that, but I'm going to go into each one of these in more detail here. So are these the right repairs and improvements? Let me give you an example. Window and door contractor persuades a homeowner they need $5,000 to $10,000 in new windows and doors. Are these the best improvements? There's no energy audit done as part of this PACE program. What if there are serious health and safety electrical problems that should be addressed instead? There's no independent inspection. So even though the windows and doors might be good, is that really the best energy saving improvement for that home? Maybe they need insulation more than they need windows and doors, but it all comes down to who's selling the product at somebody's door in their living room. Second major problem, does the homeowner have the ability to repay the loan? The Lucas County, Toledo-Lucas County Port Authority is the manager of PACE in Ohio. Now they have created a master agreement that requires strong consumer protections. And I want to point out something, it's not on my slides, but I do want to add it here. There was a pilot program, a PACE residential pilot program in Lucas County. It was done by the Lucas County Land Bank. They created their program. They looked at the PACE experience in Los Angeles, Florida, and other places, and they decided we have to add our own additional protections. So they also, some of the leaders of the land bank went to the Lucas County Port Authority and said, you need to add significant homeowner protections, consumer protections in the master agreement. And they suggested that these protections be based on California's response to the PACE program. And I'll get into that in a minute. But what happened is that the Toledo Port Authority then issued consumer protection policies that contradict their own master agreement. And I'm going to demonstrate that next. So here's what the PACE master agreement says. Section 11, consumer protections. The cooperative parties, that's Y-Green and the energy districts, agree that consumer protection standards shall be adopted for the Ohio residential PACE program. The consumer protection standards shall be substantively similar to the consumer protections adopted by the state of California for residential PACE. California amended its state laws in response to the problems that they were having with residential PACE. So here's what does California require? Section 22-687 of the California Financial Code. A program administrator, this is Y-Green, shall determine, not may, shall determine the property owner has a reasonable ability to repay the annual payment obligations for the PACE assessment based on income, assets, and debt obligations. The program administrator shall, not may, consider income using reasonably reliable third-party records. The administrator shall, and again, not may, consider the monthly debt obligations of the property owner to determine a property owner's ability to pay the annual assessment using reasonable, reliable third-party records. And down below, they define monthly debt obligations to include number 4, monthly housing expenses. But what did the Toledo-Lucas County Port Authority do with their consumer pays protections for Ohio? These were enacted originally on March 4th. They were amended on June 10th. So this is the latest version. Section 2.2, ability to pay. Now that sounds like the right thing. What it says is each program administrator shall determine a property owner has an ability to pay the annual PACE assessment, so long as the total amount of all PACE assessments on the property is equal to or less than 10% of the property owner's annual income. Example, property owner makes $50,000 annually. The improvement is $5,000 for new windows and doors. Well, based on their standards, since the improvement is equal to or less than 10% of the owner's income, they meet the ability to pay. But what if they have high monthly debts and household expenses? This isn't addressed. Section 2.2.1 says income in determining a property owner's ability to pay the PACE assessment, the administrator may, not shall, confirm a property owner's income using information gathered from reputable third parties. I want to look at this a little further. The original March 4th, 2019 version of the consumer protections did require an analysis of debt to income. These were amended on June 10th, 2021, and they deleted the following language. Debt. If a person's income is considered as part of the program's debt to income evaluation, then the program shall also take into consideration such person's debts in determining DTI. Here's the problem. The Ohio consumer protection policies that were enacted contain no requirement that ability to pay takes into consideration the owner's debts or housing expenses. They have this section that says, well, as long as their income, $50,000, 10% of that income is, the repairs are no more than 10%, a $5,000 repair with $50,000 income, that makes it okay, but that's not looking into what debts and expenses do they have. Maybe they really can't afford even that. This is a significant problem, which it's a significant omission in the Ohio program. One more thing here, Ohio's 3-day right to cancel. As many of you know or may not know, Ohio state law does require when there's a home solicitation contract, the contractor's at somebody's door, they're in their living room, they've signed up a contract for a home improvement, there's a 3-day right to cancel. At a meeting on November 21st, 2019, housing advocates were told that the Ohio PACE program would not require the contractor to leave a copy of the contract with the homeowner. It can be emailed later. How many days later? More than the 3 days? What if the homeowner doesn't check their email regularly? It's worth noting that the LA Times reported that in California, PACE contractors would flash snippets of the contract on their phone or their laptop to show the homeowner select provisions of the contract. They would sign electronically, but we'd be left with no hard copy. Ohio should have learned from the experience in California, but apparently we haven't. So here's what they did in the amended consumer protection policies. They do have a section that says printed copies of financing documents. In addition to electronic copies, each program administrator will require that printed copies of all PACE financing documents will be provided to property owners after signing. What does after mean? How soon after signing? Within the 3-day right to cancel or after the 3 days? Why doesn't it say at the time of signing? So summary of PACE risks, and again, this isn't the all-inclusive summary of PACE risks. I think we'd actually have to go back and look at Jeremy's and Steve's. Contractors going door to door, selling the PACE loan. No energy audit or other assistance to determine are the repairs or improvements the contractor selling, are they really what the person needs or should have? The loan interest could be as high as 8%. The loan will be a super priority tax lien on their home. The way it's laid out, no verification of ability to repay. They've got a verification of income, and actually it's not mandatory, they say may do it, but there's no verification of ability to repay these loans. And finally, there's no hard copy documentation left with the homeowner at the time of signing. So final thoughts, contractors in California routinely promoted the PACE program as no money down. It's a government-sponsored program, implying it was safe for residents to engage. there's every reason to assume that Ohio contractors are going to want to use these same selling points. When Ohio mayors and cities, city councils authorize PACE in their community, they will be essentially saying to their residents, they're giving PACE their stamp of approval. But will their residents be alerted to the risks that we've presented here? And I'm going to turn this over to Antoinette, because I think that I'm looking at this from a 20,000 foot level. Antoinette can give you the actual on the ground experience working with homeowners. How should homeowners be protected from programs like this? Antoinette, I'm going to stop screen sharing. And Antoinette, are you going to screen share your own your slides?
I am going to try and screen share. I've been having difficulties, computer issues all day. So I'm just asking you guys to bear with me, and hopefully I will be able to pull that up.
And if for any reason it doesn't, Catherine could probably, but go ahead and see if that works for you.
Let's see. Can you guys see? Let's see if it comes up.
It's starting to, yep. I think you just need to do
The slideshow.
Yeah, from beginning. Or from beginning on the left. Well, that maybe that works. Or,
All right. So thank you, everyone. I'm here to talk about the importance of having a third party or a HUD-approved housing counseling agency look at anyone who is potentially looking at the residential PACE programs. And so HUD-certified housing counselors, they must meet these demonstrated standards of competency. And so that is financial management, property management, the responsibilities of homeownership and tenancy. They are knowledgeable in fair housing laws and requirements, housing affordability, including DTI assessments, which is crucial, and then response to and avoidance of rental and mortgage delinquency, eviction, and default. I want to point out, at the height of the foreclosure crisis, homes were being sold sight unseen, along with predatory lending. Clients were being put into unaffordable mortgages with balloon payments that are still currently becoming due. There is a big concern, as you know, Frank, Jeremy, and Steve have presented, with clients being able to afford the residential PACE program. A financial assessment is key in making sure that the client will be successful in paying back that loan. So when a housing counselor assesses a client's situation, they are not only looking at the income, they're looking at debts. Not only debts that are listed on the credit report, but also taking into consideration debts that are not listed on their credit reports. So as an example, we're talking about property taxes. There are many clients who are on repayment plans for their property taxes. So if a client is already on a repayment plan for their delinquent property taxes, they could not afford another lien on top of the already delinquent taxes that they're paying. So this makes the increase or the risk higher for that client to lose or be at risk of losing their home. Not only, Frank had mentioned with the contract that it is being sent by emails, but what if a client doesn't check their email regularly? Well, I'll say one better. What if the client doesn't have access to technology, right? There is a huge digital divide. We have a program where we are trying to teach seniors, how to use technology, because it is something that is not going to go away, and it is something that they need. But if someone comes to their home in certain neighborhoods, so I'll use the example that Jeremy had with that particular client, no access to internet, no access to, they don't even have technology. So it will be extremely difficult for them to be able to review any type of documentation. So we have to keep that in mind. So sorry, this is going backwards. So also HUD certified housing counselors deliver all of these type of programs. There are many of the programs that ESOP's HUD counselors look at. I want to focus on the recognizing fraud, financial fraud, and scams. As mentioned previously, the client would not be given a copy of the contract until after they have to sign it, which means that they don't have the ability to really read it and know what they're getting into. The PACE program has the potential to fall into financial fraud and scam because there's no regulation of the program, there's no control of people going door to door, and more importantly, there's no one available there to advocate for that client. Implementing a HUD certified counselor or a third party would remedy that by first assessing two things. Number one, it assesses the client's ability to repay. And then number two, assessing and talking with the client to see if they would actually need the repairs that are being presented to them. And so we want to ensure that the client knows everything that they're getting into. We want them to clearly understand the implications of the taxes being, the expense being tacked on to their taxes. And so that goes with being educating the client as to what they're getting into. Again, before putting a client into any type of loan situation, the HUD certified counselor will look for other alternative programs geographically that could possibly assist the client with the needed repairs. So programs like the HELP loan or Cuyahoga County home loan program with partners like CHN. HRRC in our area has a home repair program. Community Housing Solutions has a home repair program. So there may be other similar programs available in different areas depending on where your client is located, but there could be safer alternatives for our clients. And with those programs comes financial and housing stability education. So they're not just coming to get a home loan. These other programs also provide the client with financial and housing education, which is what is needed so that the client clearly knows if what they're getting into is affordable to them. It also helps the client determine if the residential PACE program is the right type of product for them. So I would say in terms of the residential PACE program that it is imperative that the client seeks a HUD-approved housing counseling agencies to help them walk through and know if that product, one, is affordable to them, and two, if the product is right for them. I recall a client, and this is not even with the PACE program, we talked about contractor misrepresentation, and it was someone that came and knocked on her door and told her, okay, we could help you with, example, new windows and help you fix your porch steps because her porch steps were dilapidated. And so she's 91 years old. She, again, to Jeremy and Steve's point, she just wanted to make sure that the house didn't crumble around her. She wanted to remain in the home. She had been there a while. The home is paid for. And so she went with this contractor, got the things half done, or in some of them not even done. Her steps are still dilapidated today, but she is responsible for $12,000 worth of work that had not been done on her property. But it is something that someone came to her door, knocked on the door, said, yes, we can do for you. And now she is in jeopardy of getting ready to lose her home. And so if we fast forward this to the PACE program, this is just one example of many where clients in undesirable, unfortunately, disadvantaged neighborhoods are going to be targeted. And so we want to ensure that those residents remain safe. And the question then becomes, if the home is literally crumbling around them, is it a good idea for that client to even remain in the home? And so that is another conversation that should be had with that client with a certified and skilled housing counseling agency or third party. And so I'm going to pass it back over to Molly for any questions that anyone may have.
Thank you, Antoinette, and everyone for your presentations and sharing all of that valuable insight and information with us. There's a lot of questions swirling around in my head, and as we've talked about PACE over these last several weeks here, I think the first one I want to ask is, and as Frank said about the rating of homes in Cuyahoga County, Cleveland, and surrounding communities, is PACE needed in the market? If there is a need for home repairs in communities that have aging populations who need repairs done and aging housing stock, who is this PACE program for? And is this the product that fills that need for home repairs? So I'd actually kind of like to hear from everyone on their perspective on that.
You want to pick on us?
Yeah, well, whoever wants to speak up first. I mean, for Frank, you go ahead first then.
Well, I am pretty passionate about believing that there's a serious need for home repair and home improvement resources, as documented by a pretty, important survey, door-to-door survey of every home in Cleveland. It's just, but the question is what, as you're pointing out, and I just have trouble believing that if the homeowner who's faced at their door with a contractor who may now be in their living room, is trying to sell them something, if they could unwind that and instead be asked by someone like Antoinette, if they were put in a position to be able to reach out to them first or before they close the deal, say, yeah, okay, what do I need here? What repairs do I actually need? Which ones are most energy efficient if I did want to go that route? And then what's the product? Is the 8% interest product the right product? Is a product that's going to go on my tax bill the right product? And as Antoinette pointed out, there are other home repair programs in Cuyahoga County, and I would bet with some certainty that Hamilton County, Montgomery County, Lucas County, you name it, counties around the state probably have some type of home repair programs that are alternatives. My biased opinion is that I think that this is something that on the surface looks really good. I mean, if those of you who have seen the John Oliver video know that President Obama endorsed the PACE program over 10 years ago. And I think that many of us in Cuyahoga County, when we first heard about it, thought, well, this is great. We need another tool in the toolbox. We need another resource. And it was only when people started peeling away the layers and looking, and then you start to ask the question, as Molly, you were asking the fundamental question, is this really the right program? And it could be the right program for some people, but it's certainly not been the right program for many people. And let's see, Jeremy or Steve, Antoinette, you guys want to weigh in on Molly's question?
Yeah, I would just add that, like many of the panelists have said, there are lots of ways governments can incentivize energy savings at home. Counties across the country have loan loss reserve funds available to backstop credit union loans. Some utilities have something called PAYS, P-A-Y-S, which is pay as you save, which is it's considered an on-bill tariff it's similar to PACE, but it just is on your utility bill. But the interest rates on those loans tend to be much lower, 4% at a maximum. And then, a lot of the homeowners that we featured in our story, probably if they had somebody advocating for them, there was some just free program available through a nonprofit or through another city program where they could have gotten what they needed to be done for free or for very little cost. So yeah, like, it may make sense for someone to, if they make too much money, they're above the federal limit for weatherization assistance. If they have a bankruptcy in their past, but they have income, it may be something that makes sense if you think that you can, get energy savings out of it, that'll basically equal the cost. But for a lot of people who are attracted to the program, there might be a better way to get the job done.
And I think many people would probably be attracted to the program because they're at their wits' end. They need the repairs done. But, as a housing counseling agency, we always want to give them resources where we're first looking at non-loan options to help them fix the problem. And especially when we know that they're on a fixed income. And so if the PACE program is 10% of, their annual gross income, that wouldn't be a lot based on the clients that we serve, enough to repair anything, because it would be, our typical client is like $20,000, and that's $2,000 worth of repairs. And so that wouldn't be a substantial amount to make any type of repairs anyway. So we always look for the non-loan option for that client first.
And just to wrap up, and I think it might go to a different question, also the program has to have safeguards in place that are enforceable, that are clear, and that make it safe. And none of the, as Frank, I think, pointed out, the ability to repay standard is just, it's not clear. It doesn't have kind of the basics of a true ability to repay standard, and there's no consumer remedies attached to it. So it's just a vehicle out there to do some of what Antoinette said is be another wave of loans that could go south and could really do some harm if the proper protections aren't in place.
So given that, there seems to be a lot of considerations that communities are going to need to take into account, and those could fall at different levels of government. So as an example, right, the state of California addressed this statewide. But from your perspective, what should cities and communities in the state of Ohio take into consideration, and what could they insert into this program to make it safe for residents, or safer for residents?
And I'm not sure who can answer that, because it's the question is, can we put guardrails on it if we approve bringing this program into Cleveland? Are there examples of other municipalities that put additional guardrails on it outside of what the state says?
Mm-hmm.
Well, I think the community should ask is what's being provided in terms of consumer protection sufficient for their communities to be safe. And I think, as Frank spelled out, the answer is no, under what the consumer protections are. And so I think from a community perspective, decision makers can look and say, this program isn't going to be a safe loan program for the people in our community. And then I think it's a matter of whether there should be further. That's the issue that's presented right now. Communities are being asked whether to adopt this program or not. And if it's not safe, then communities could say, well, we would do this under these particular situations that would be more protective, and then see if the pay, set a standard for what a safe PACE loan is, and then see if the industry is responsive. Maybe this would be better to happen at a state by state level. I would tend to think that elevating the consumer protections from a statewide level may be better. But I think in terms of the decision that's in front of folks right now, it's whether these protections that are in place meet up to kind of very basic standards of what would be a safe loan program. But Frank, I'm curious I think I cut you off, what you have to say to that.
Tony's raised a good question, or see, I'd made an assumption, I've been making an assumption that municipalities could in the ordinance, they'd have to pass an ordinance saying, we approve PACE coming into our community. That in that same ordinance, they could say, but we're adding the following additional consumer protections. Most typical one would be, there's got to be more on the ability to repay. There's got to be more, similar to what California required. But Tony didn't say it exactly, but I'm wondering, I guess the law department of each municipality will have to do a little research to make sure there's nothing they'd be enacting that isn't already preempted somehow by state law. I don't think there is, but I'm going to say it's worth looking. It's something that would have to be looked into. But I still think the fundamental question, if a municipality wants to go forward with this, they should definitely look into seeing, can they impose additional consumer protections? Because the likelihood of getting our state legislature to do what California did, I hate to say it, but the Ohio state legislature is not the California state legislature. But yeah, one can hope, of course. Hey, before I forget, there's something I'm afraid that I'll forget. I mentioned that there was a Lucas County Land Bank pilot program, and I think I left that hanging out there without saying something really important. That pilot program was successful. I think they did about 50 PACE loans. But here are the things that they instituted in their program because they saw the shortcomings in what was being proposed. They did exactly what Antoinette said. They talked to the homeowner first and helped them figure out, well, is this the right, do you need an energy efficient improvement? Do you need new solar? Or is insulation better? Or windows better? Or in fact, is it really more important that you get your serious health and safety issue fixed with your electrical and plumbing? And they didn't do a PACE loan in some cases. They instead helped the person get some other program, some other repair. So they weren't, it's not like they had to do X number of PACE loans to meet some standard. Their goal was, what does the homeowner need? But then when they did engage with a PACE loan, they made sure that the borrower had the ability to repay. They looked at all the same things that Antoinette talked about. They verified income through third-party verification. They looked at all the debts and expenses, even the ones that wouldn't necessarily show up in a credit report. And, you know, that was a safe program. I mean, as Steve said, if you're going to do PACE, make it safe. The Lucas County Land Bank really set the gold standard. But what's the downside? Well, they had to spend some staff time. They had to do staff time with some helping that homeowner assess the home. They did an energy audit. So, you know, that's the downside. But, you know, do we want a program to go forward that might hurt people? If we don't, we may have to face, well, how are we going to make this work? So.
Yeah, can I add something to that? Far be it from me to advise what a local government should or shouldn't do as far as PACE goes, but I also wanted to talk about the Toledo Lucas County Port, their pilot program. You know, the biggest consumer protection that I see in that program is that it was just a lot cheaper than a PACE program through Y-Green or Renovate America. The cost to the borrowers was so much less. I also did a story about comparing similar projects that the pilot program did to what Y-Green or Renovate did in Missouri, and the amount of interest that people are paying on the Toledo Lucas County Port program with the land bank is considerably less. You know, when you stretch out a loan over 20 years, the difference between 4% or 4.25%, which is what they were charging, to 10 or 11 or 12% APR in Missouri, the amount of interest is tens of thousands of dollars in some cases. And so what could a local government do? You could run your own PACE program. You don't need to use a national lender to run it. You know, and that's one of the questions I had for the Toledo Port. You have a program. Why is it important to go to use Y-Green, to use a private lender that might increase the cost? And the answer was, well, we can't do a statewide program if without them. Then the question is, well, then why do you want to do that? Why can't Cleveland have its own program? Why can't Akron have its own program? Why do you need a statewide program to do that? So, other local governments could do what Toledo did, which is run its own program to meet a need for people who, need home repairs and might not be able to have other access to credit.
And I would add one thing. I would not call the Toledo Land Bank program a pilot, because I believe it is a fundamentally different program than what Y-Green is presenting. This contractor orientation aspect is big. The idea of, instead of loans being originated, essentially, we'll call them loans because that's what it seemed like, PACE loans, through a contractor either going door to door and in some other engagement, versus engaging with the land bank to assess all of the different repair issues, and then maybe PACE being the option. And then the difference in how much interaction between the land bank and then the price. These are essentially apples and oranges as far as I'm concerned in terms of orientation. And to say a pilot, to me, implies that this is a stepping stone that would be then broader, and certainly what Y-Green and the Toledo Port is presenting is broader, but it is a fundamentally different type of program than what the land bank did. And I think it's worth noting, and everything that, for every reason that Frank and Jeremy said, I think it's, I think it's just like so different. I wouldn't call it the same thing.
So that's getting to a question I do want to ask, but first I'd like to ask a question that was posted in the chat that kind of follows up on what we were just talking about, which was, could communities maybe mandate some of this through building code inspections or permitting in some way tied to these loans and the work done by these contractors?
So I think I'll leave some of this to Frank, but I think that I think that you could have, more engagement in terms of the quality of work, but what is important on PACE is it does have these two components with it that does not address ability to repay, right? You really need robust, thorough ability to repay requirements to make sure that even if the work is done well, that the homeowner can afford it. So it doesn't resolve everything, but I do think like further contractor and building oversight is important. I'm curious what others think about that, though.
And I would probably add that generally, if you use CDBG dollars, you must bring the house up to code. But since this isn't CDBG dollars, it's a separate private loan. Requiring the property to be up to code or having a building inspection done probably isn't warranted. And I would probably also add, there are cases, we are talking about most likely being used on low value homes as a last measure to get your furnace working or get your roof to stop leaking or get more efficient windows. I think that bringing the code inspection probably complicates it. I don't want to minimize that, but quite frankly, I'm looking at this as a real last ditch effort to have a repair made in your home, not as a real. I'm not looking at this as an energy efficiency program. I don't think it's ever been used as that. When you look at some of these states, it's just been a loan program as a last tool loan product available.
I was just going to say that I think that a lot of homeowners who have a $2,000 repair, who cannot find cash for a small repair of the porch or whatever it is, or a portion of the roof, delay the repair. So there's deferred maintenance. And so many of these properties, older homeowners and older homes have this deferred maintenance. And so if you had some kind of inspectional services in older cities, and Phil Starr used to have some in neighborhoods where they would go through, instead of being a complaint driven system, It was exterior inspection. And then the city is there to kind of run interference with the homeowner and the contractor to get the repairs done before the thing falls apart. And I think the reason that Frank found so many DNFs in Cleveland is that there is no mechanism to prevent them from falling farther and farther behind. I always thought one of the better things we did in Cleveland Heights back in the 70s was our inspectional services program. And we were able to get resources to homeowners through the Home Repair Resource Center. I think that's a critical thing, an intervention you can make, whether it's for, health and safety or whether it's energy efficiency. But everything that when you bring a private contractor going door to door, it just absolutely reminds me of the early days of subprime lending. They were going door to door with the roofs and the gutters and all the other stuff. It's the same thing. I mean, it is identical. And the worst part of this is that it's the government that's doing it. They're selling these notes, whoever's Toledo Port Authority. And I know the realtors hate code enforcement, but one of the ways that we finally brought them on board in Cleveland Heights was it raised the value of all the homes in the city because nothing was falling apart. And I think you need to do that, and you need to make that part of it. And if you have a corrupt inspector or whatever, you got to get rid of them. I've often argued that we should use the fire department. After they're flushing all the fire things and running around doing that stuff, they could be the inspectional services department because they do it for commercial places. They do it for buildings. They make our communities safe. And we have example after example in Shaker Square where large, beautiful apartment buildings are just falling apart because there's no inspections. And they're allowed to fall apart. Then the city is willing to spend literally millions of dollars to demolish properties and not save them and maintain them. And this is what we get into every time. I mean, we've had these programs around, and I think, Frank Ford's stuff about every year we do this, the lenders, and the lenders just don't want to make these small dollar loans. They're just not interested in them. It's not big bucks for them. And it kills neighborhoods. I mean, it's the final straw in the back for Buckeye Woodland or Slavic Village or, wherever the neighbor Union Miles or wherever it is. So that's my thought about it. It was a great presentation. That research you did in St. Louis County I hope you guys got an award for it. That's terrific stuff.
Thanks, Chuck.
So each of you, and Chip, you just got into this a little bit also, is the example that the Toledo program wasn't a genuine pilot program. They were, running something. And then you have people have brought up other programs across the county, like that Home Repair Resource Center has. So are there other ways to do this and other resources that communities could be pulling from? And when I ask this question in the back of my head, I'm thinking right now of this unique place that communities find across the country, not just in Cleveland, find themselves in with the pandemic and recovery. And so now there's ARPA funding that is flowing into many communities. And what are there ways that we could bring some of the existing nonprofit resources and other programs that have been in communities for years to scale to address these kinds of things? So what are some of the other ways that we could do this? What would it take for Cuyahoga County to replicate the Toledo Ports program? What would that funding look like and where could that come from? Whoever wants to dive into that one.
Is it okay if it be a non-panelist? Because there are people in the audience who are really expert, and I'm going to pick on somebody. She probably knows I'm going to do it because I've heard her talk about this. Sally, could you share your thoughts about what is the alternative that could be done with money that's available?
Oh, Frank, you picked on me. I knew you would. I think I've been pretty public about saying that if the port is willing to float bonds for this, we have in Cuyahoga County a wonderful array of housing counseling agencies who are able to implement loan programs. like the Challenge Loan in Cleveland Heights, like CHN Housing Partners and ESOP. And I think that's where I would put those resources if they were available. And I think throughout the state of Ohio, there's similarly situated housing counseling agencies that could do the job for us the right way.
Now, what are the elements that are the right way? So I'm, trying to get here to, shaping recommendations for what could happen in Cuyahoga County. There are, as you mentioned, Sally, there are wonderful housing counseling agencies that have been working in Cuyahoga County for decades, and certainly intensively during the foreclosure crisis, and building their resources and capabilities over that time, and have saved thousands of homeowners. So how do we leverage that? What are, some policy recommendations today to put in place to help with repairs for seniors in vulnerable communities and in communities where loans aren't being made?
Well, if you're asking me, I would say
I'm
the
asking
model
everybody,
is already
but
there.
that's you too.
Yeah. Yes, I think the model is there. If you look at how the Challenge Loan Fund operates, if you look at how CHN Housing Partners Home Repair Loan / Grant operates, a lot of hand holding, a lot of working with the consumer to identify contractors, to make sure the work's getting done, paying contractors directly. That's the type of thing that Y-Green isn't prepared to do, that I think that the nonprofit space works best at.
And just to kind of just piggyback off of what Sally said, I mean, we're already there. We already have the mechanisms in place, right? We already know, we've already been working with the clients, and, a lot of the clients have been with us for quite some time, and, no client comes with just one issue. And so in solving their issue, we try to solve the issues in stages. And first we try to, of course, get them out of the crisis, because they always come to us in a crisis. And so the first thing is getting them out of the crisis, and then moving towards, okay, what else does this client need, and taking that need in phases. And by doing that, utilizing, like Sally said, all of our resources. So if it's HRRC, if it's Community Housing Solutions, if it's CHN, we're all partnering together to make the clients to meet the client's goals in terms of sustainable homeownership.
Keisha, is that you with Home Repair Resource Center there? I see your hand raised.
Yes, I am not dressed to be in front of all of you today, so with my cap on. But yeah, I 100% vouch for. I appreciate all of my peers advocating for something that we've been trying to push, obviously, for probably at least half a decade. Our very unique program, our Challenge Fund Loan Loss Reserve Program, and without getting on my soapbox and talking about the values of this type of program, one of the things that jumped out to me that Frank spoke about is where I think we kind of have that expertise is, aside from being a HUD approved counseling agency, our expertise is the repair management portion. So where, folks are getting windows or high efficiency HVACs or solar panels and things of that nature, where I'm doing air quotes are technically upgrades. We kind of intervene in that space where we can kind of articulate what needs to be done now, what resources are available through grants or other funded programs, and then what can we plan for in the future. Things are changing, and to put something on someone's taxes or make them have a negligible asset for the purposes of doing some of these repairs is kind of mind-blowing, because they may not need it. So when you kind of talk about kind of interventions, and Councilman Bracatelli talked about the CDBG money, that's why programs like the Challenge Fund is different. It's not those income guidelines that most of the CDBG or HUD funded programs are, as well as the fact that the repairs are a little bit different, right? And you can kind of get your garage done, get your asphalt done, get some things done that aren't necessarily just health and safety. So where that kind of private public intervention kind of happens, and they rely on folks like my team and our peers at the housing counseling agencies, I think that's the way we kind of do this and we get this push forward, because having these, you know, kind of out of state or national folks coming in, they don't really understand our housing stock. They don't understand the neighborhoods that we work with, and kind of how to make sure this works in a way that we have safe and sustainable neighborhoods. So that's kind of my input. So thank you to all the panelists, Steve and Jeremy. That was great information, just to show that, you know, this is definitely something that, if brought to Cleveland or the Northeast Ohio area, could benefit some, but I think it's going to be disadvantageous for most.
Yeah.
And I think what's really important about the comment is it really, and sort of tying it in, it really addresses, like, rather than talking just about energy efficiency, talking about programs that actually address the needs on the ground. Because while maybe, as a council member said, PACE hasn't been actually used for energy efficiency, it is certainly sold as such and supposed to be. And that provides the contractors with the fodder to make some of the claims that Jeremy's unpacked, that John Oliver have come back. And those are the selling points that can pull people into something that isn't actually valuable to them. But instead, let's focus on what is really needed on the ground. And I think kind of that focus is important, because then when you have PACE, then you have to really see when there are these claims about energy efficiency and claims about what contractors are doing, then it is really a matter of, okay, but then are there these actual remedies and consumer protections in a place to make sure that they are getting something that is definitely within their ability to repay. And the standards just need a lot more to actually live up to that.
So this, you know, it's very concerning for me that, you know, we're talking about these kinds of tools and mechanisms being deployed in places in our communities that are still working hard to recover from the mortgage crisis. And that's where a lot of the burden of this is going to be seen. And then there's a lot of housing issues, and this idea of, you know, what is sort of a broad spectrum of programs and activities to make our housing healthy. And I don't just mean that in repairs or in lead safe. I mean, right, healthy home ownership and all that comes with that. So given the fact that we are approaching our end of time here, I want to give each panelist an opportunity to give one last perspective on PACE, and certainly for communities considering this program, because there are many communities, not, you know, across the state, our neighbors maybe, who are thinking about bringing this to their residents. What are the top recommendation each of you would have for council and mayors and communities considering these agreements?
And keep it clean, no F-bombs.
Yeah,
Yeah, we're not done all this. I would say, look, I think there are very basic requirements in terms of making sure that borrowers have an ability to repay that need to be in place in order to make this safe. And they need to be actual documentation, ability to repay standards that truly take into consideration verified debt, and also a clear statement of what affordable, safe ability to repay standards are. And then if those standards aren't met, what are you going to do in order to make sure that people who have loans that don't violate the law, what kind of remedies are in place for those? And those need to be the standards that are baked into a PACE program. We've seen the consumer protections. They need a lot that are being pushed. They need a lot more to reach even those basic standards, as Frank has set out, truly looking at debt and income, truly looking at ability to repay and consumer remedies. And a lot more is needed than what is being out there. And so I think cities, municipalities need to demand a lot more in order to make sure they have a safe program for their constituents.
Jeremy?
Yeah, I can't make any recommendations, but I can make an observation. The boards that were set up to regulate the PACE lending in Missouri did nothing. They had no idea until we told them that people were delinquent. They really didn't understand the cost, how 8% becomes 12%. They were surprised by some of the homes that we showed them, the $2,000 house, things like that. And that has not worked out well in Missouri. So, I mean, the boards really have been run by the lenders. And the board members just consider themselves community volunteers that are, involved 4 times per year at a meeting. So that was one of the biggest failures in Missouri. There was no oversight. There was no state oversight. There's no local oversight. I should have mentioned earlier that after our stories, during our stories, there were some bills filed in Missouri that the governor ended up signing. It does create some state oversight. So the Division of Finance actually will audit each of the PACE programs, I think every other year, and then have the ability to ask questions about what's going on here. Why are there so many delinquencies? So, I think one would hope that some of the problems, if they continue to develop in Missouri, would be caught at the state level, because they're not being caught at the local level.
Frank?
Well, I'm thinking 4 things. One is, this is what I would say to a mayor or city council anywhere in the state of Ohio that's thinking about this, is you got to make sure, as Steve said, that you've got provisions for the ability to repay. And that's not currently, you'd have to add that somehow. And the second, you have to have some provisions to protect your homeowners from being sold something they don't need, or is not the right energy efficient product for them, or maybe they need something for health and safety. The third thing is, I would say, watch this 2-hour video. And the fourth thing is, if you don't have time for that, watch the 20-minute John Oliver video. Those are my 4 recommendations.
Antoinette?
And Steve, Frank, they've said it all. We just really want to ensure that borrower has the ability to repay, making sure that they're not getting into something that they don't need, and also making sure that they're truly aware of the consequences, right? They have to know the ramifications of if they don't pay, and how that is going to affect them in terms of their taxes. And I think just knowing that alone, some would really pause, because they're already having difficulty, maintaining and taking care of those taxes anyway. So.
Well, thank you, everyone. I will say that this video will be available in due course on the Ohio Fair Lending web pages. Chip, I hope that's correct, that's right, where it will be located.
We will store all that there. And I just want to thank Molly, all our panelists. And I forgot, this is, I think, their first forum. We've had our new Vista, Catherine Rolinke, who is a graduate of Ohio State University's planning school, and graduated with honors and started out with us, and is dedicating a whole year of ending poverty in Ohio. Wish her well, and enjoy her working with us, and recognize the value of Vista and AmeriCorps as part of the integral part of working on the very difficult issues that our city faces. I want to thank her. I want to thank all the panelists and all the participants. And of course, our funders, and you, Molly, and Cleveland State University.
Be a part. Thank you, everyone.
Thank you.
Thank you.